S&P 500 and NASDAQ closing at all-time highs. The Dow up, gold up, real estate.
Hello and welcome to another TrendSpider Technical Analysis Series video. In this video, we're going to be talking about the 5 chart patterns that every trader must know. Let's jump into it. First up, we have triangles. And there are 3 different types of triangle patterns to be aware of: ascending, descending, and symmetrical. We'll start with ascending triangles, which are characterized by a rising trend line that connects higher lows and a horizontal resistance line that connects equal highs. This pattern typically forms during an uptrend, signaling a possible continuation of the trend. Oftentimes, volume will decline as the pattern progresses, with a potential increase in volume upon the breakout. Want to trade it? Here's how. Look for a confirmed breakout above the horizontal resistance line accompanied by an increase in volume. Set your stop loss below the rising trend line or the most recent swing low. A price target can be estimated by measuring the height of the pattern and adding it to the breakout point. Next up, descending triangles. Descending triangles feature a falling trend line connecting lower highs and a horizontal support line connecting equal lows. Typically, these form during a downtrend, signaling a potential continuation of the trend. Volume tends to decline as the pattern progresses, with a potential increase in volume upon the breakout. To trade it, look for a confirmed breakout below the horizontal support line, accompanied by an increase in volume. You can set your stop above the falling trend line or the most recent swing high. A price target can be estimated by measuring the height of the pattern and subtracting it from the breakout point. Our last triangle is the symmetrical triangle. Symmetrical triangles consist of converging trend lines connecting lower highs and higher lows. They can form during both uptrends and downtrends and signal a period of consolidation before a potential trend continuation. Volume tends to decline as these patterns progress, with a potential increase in volume upon a breakout. If you'd like to trade these patterns, make sure to wait for a confirmed breakout above the upper trend line for a bullish signal or below the lower trend line for a bearish signal, accompanied by an increase in volume. Set your stop loss below the most recent swing low for a bullish breakout or above the most recent swing high for a bearish breakout. A price target can be estimated by measuring the widest distance between the trend lines at the start of the pattern and adding or subtracting it from the breakout point. Our next pattern is the wedge pattern, of which there are 2 types, rising and falling. Rising wedges are characterized by converging trend lines connecting higher highs and higher lows. They can form during both uptrends and downtrends, but are typically considered a bearish reversal pattern when formed during an uptrend. To trade them, look for a confirmed breakout below the lower trend line accompanied by an increase in volume. Set a stop loss above the most recent swing high, and a price target can be estimated by measuring the height of the pattern at its widest point and subtracting it from the breakout point. Next, we have falling wedges. Falling wedges are characterized by converging trend lines connecting lower lows and lower highs. They can form during both downtrends and uptrends, but are typically considered a bullish reversal pattern when formed during a downtrend. If you're trading them, look for a confirmed breakout above the upper trend line accompanied by an increase in volume. Set your stop loss below the most recent swing low, and a price target can be estimated by measuring the height of the pattern at its widest point and adding it to the breakout point. Our next pattern is the head and shoulders and inverse head and shoulders patterns. Head and shoulders patterns consist of 3 peaks. A higher peak, the head, lies between 2 lower peaks, the shoulders. A support line, called the neckline, connects the 2 lowest points between the peaks. Typically, these patterns form at the end of an uptrend, signaling a possible trend reversal. To trade a head and shoulders pattern, first look for a confirmed breakout below the neckline, accompanied by an increase in volume. Set a stop loss above the most recent shoulder or just above the neckline, and a price target can be estimated by measuring the height from the head to the neckline and subtracting it from the neckline. Inverse head and shoulders patterns consist of 3 troughs: a lower trough, the head, between 2 higher troughs, the shoulders. A resistance line, called the neckline, connects the 2 highest points between the troughs. Typically, this pattern forms at the end of a downtrend, signaling a possible trend reversal. To trade it, look for a confirmed breakout above the neckline, accompanied by an increase in volume. Set a stop loss below the most recent shoulder or just below the neckline. And a price target can be estimated by measuring the height from the head to the neckline and adding it to the neckline. Our next pattern is the channel, and there are 3 types of channels to be familiar with: ascending, descending, and horizontal. Ascending channels are characterized by 2 parallel trend lines with higher highs and higher lows. They typically form during an uptrend, signaling a continuation of the trend. Price oscillates between the trend lines, moving in an upward direction. If you're trading them, you'll want to buy near the low trend line, support, and consider taking profit near the upper trend line, resistance. You can set a stop loss below the most recent swing low or just below the lower trend line. Breakouts below the lower trend line can signal a trend reversal. Next, we have descending channels, which are characterized by 2 parallel trend lines with lower highs and lower lows. These typically form during a downtrend, signaling a continuation of the trend with price oscillating between the trend lines. To trade them, sell short near the upper trend line, resistance, and consider taking profit near the lower trend line, support. You can set a stop loss above the most recent swing high or just above the upper trend line. Finally, we have horizontal channels, which are characterized by 2 parallel horizontal trend lines connecting equal highs, resistance, and equal lows, support. Typically, these patterns form during periods of consolidation, indicating that neither buyers nor sellers have control, with price oscillating between the trend lines, moving in a sideways direction. To trade a horizontal channel, you'll want to buy near the lower trend line, support, and consider taking profit near the upper trend line, resistance. Set a stop loss below the most recent swing low or just below the lower trend line. The last pattern that every trader should know is the double top and double bottom. Double tops consist of 2 nearly equal highs with a moderate trough between them. A support line called the neckline connects the 2 lowest points between the peaks, and they typically form at the end of an uptrend, signaling a possible trend reversal. To trade a double top pattern, look for a confirmed breakout below the neckline accompanied by an increase in volume. Set a stop loss above the most recent swing high or just above the neckline, and a price target can be estimated by measuring the height from the highest peak to the neckline and subtracting it from the neckline. Double bottoms are the opposite of double tops. They consist of 2 nearly equal lows with a moderate peak between them. A resistance line called the neckline connects the 2 highest points between the troughs, and they typically form at the end of a downtrend, signaling a possible trend reversal. To trade a double bottom, look for a confirmed breakout above the neckline accompanied by an increase in volume. Set a stop loss below the most recent swing low or just below the neckline, and measure the height from the lowest trough to the neckline to determine a price target. Knowing what chart patterns look like and how to trade them is one thing, but finding them can be time-consuming. With this in mind, TrendSpider offers auto discovery on many of the patterns we've discussed in this video. Let me show you how it works. In order to have the platform automatically display a pattern on your chart, click the Chart Patterns button and select the pattern you wish to see. If that pattern exists on the chart, it will be automatically drawn for you. There are a number of ways chart patterns can be utilized within the platform. First, you'll find them available as a parameter within your market scanner. Want to search for all tickers within the S&P 500 that have ascending channels on the hourly time frame? You can do it. You can even scan for things like breakouts, consolidation within the pattern, or breakdowns using one of the many shared scanners that are available. Simply type in the pattern you're looking for in the search bar, and a series of options will populate. For example, if you're looking for the price oscillating within a symmetrical triangle, choose the Symmetrical Triangle in Force option. Still, another way to utilize chart patterns on the platform is within the Smart Checklist. The Smart Checklist is helpful if you want to know that a pattern exists on the chart but don't want to visually see it drawn. Simply create a script containing the patterns you're interested in, and then utilize that script in the Smart Checklist. The checklist will return a list of all the patterns currently present on the chart in real time. So there you have it, a simple breakdown on the 5 chart patterns that every trader must know, how to trade them, and how to utilize them on the TrendSpider platform. I hope you found this video helpful, and I look forward to seeing you in another TrendSpider technical analysis series video soon. As always, happy trading, and catch you next time.